Our savings pool is growing, but our stock market is shrinking. Why the head of one of the country's biggest wealth firms is worried we're becoming more like Suva than Singapore.
Well, at the moment we don't have access to the size of opportunity we need to deploy it into New Zealand, so we are deploying it overseas because it is also achieving diversification for our investors and accessing product and returns which you don't get here.
So is that suggesting that the government then could look or should look to selling off some of their stakes in the gentailers, in the likes of Air New Zealand or councils in their port ownership?
Those organisations will do what's appropriate for their balance sheets. If they do that, that is an example of how you would get more liquidity into a market.
You might create some enemies from this chat, so you prepared for that? MJ, good to see you. Thanks so much for having us in.
Welcome back, Madison. Good to see you.
It is always good to be back. Why do you think we should have this conversation now? Why do you feel it's important for you to talk about it?
There is a lot of stuff which is going on, and there's a lot of positive actions which are being taken by the industry and market participants as a whole. And I think that at times when you step back and acknowledge some of those things which are taking place and actually commend some of the people who are really leaning into trying to solve the problem.
What is the problem? Can you size it up for us? Why is our capital market shrinking?
Well, capital markets, people often think of the listed markets. In New Zealand, that's the NZX, but there's also private markets. And with the savings rates growing in New Zealand, which is a positive thing, we need to be able to deploy the money both here domestically and overseas. We've got great returns overseas, we're getting okay returns here in New Zealand. As our savings industry grows, we need our capital markets to grow as well. One of the problems we have at the moment is we need to be an attractive place to list. We need to have a liquid market as the second piece, and we need to have a market which instills confidence for people to put long-term capital to work in the private setting because they don't have the liquidity. So those are the three core buckets of the problem we've got.
Focusing on the savings pool first, how much has that grown? What are you seeing at First Cape, and how much is that continuing to grow and why?
We're seeing savings growth coming from two main areas at the moment. One is the KiwiSaver, the mandated inflows. That system's working. The other area we're seeing the market growing is from market returns. Those market returns, again, coming from New Zealand and offshore. The offshore market, in particular the US, has been performing incredibly well this year, in the region of 20% growth year to date, which is more than we're seeing here domestically.
So First Cape looks after how many billions of dollars?
We're about 51 billion at the moment, so directly and indirectly looking after the savings of about 800,000 New Zealanders.
Where are you allocating that then? What's the percentage split between those offshore opportunities where returns are right now larger?
It varies for each of the individual pools of savings you have, depends on how much you'll allocate overseas, but given the size of the New Zealand market, as an industry, we need to allocate more of our savings pool overseas than we do here domestically.
Is that like 51 to 49, or is it more like 70-30, 80-20?
It's over 50% of the industry would be overseas.
But that is your obligation, right? You have to chase better returns for investors, and you just feel like those opportunities are not here.
You have to chase returns, but you have to chase them safely, and the safety comes with diversification. The New Zealand market's quite a concentrated market. The companies on the exchange are quite concentrated, and you get some of that diversification of exposure to different industries by being in other geographies.
So as that pool that you look after grows and you have to chase bigger returns for those clients, does the threshold for a size company or size investment you put that money into get bigger as well?
That goes to the problem we were talking about around liquidity. That's the amount of stock which is available for buying and selling in a market on any given day. As the pools of money you put to work are bigger, if you decide not to be in a stock, you need to move more and more of your money out of it. So you need to have depth of liquidity in stocks as you get bigger. Given the size of the saving pool in New Zealand, the number of companies which are meeting that threshold is actually becoming smaller because they're not keeping up with the rate of growth in the savings industry. That's not a bad thing, that's just a natural evolution for the market. But there's probably within the industry this is not just a First Cape statement, but probably across the industry, the top 15 companies in New Zealand probably meet the long-term liquidity requirements for long-term deployment for a growing savings industry. Those stocks will also need to keep up with the liquidity requirements of the industry. So it'll be an interesting challenge for the market to keep up with the growth of the savings industry.
So there's only 15 companies in this country on our stock market that actually meet the threshold of investable for our savings pool right now.
There's a few more, but that tends to be the number, give or take a few, which companies tend to put their portfolio allocations into.
And if you consider takeovers that we've seen over the past few years, I mean, the number of large cap companies in this country is only shrinking. Other than takeovers, like, what do you think the problem is? Is it that these companies can't grow, therefore they're not becoming more attractive, or are they just not releasing their liquidity onto the market like they should be?
Well, in relation to, we're talking about public equities at the moment, in relation to the sort of two challenges around the public equity markets. One is we need to be an attractive place to list, and so we need to make sure that we're not a place which is unattractive to list, and ensuring that the balance with regulation and listing rules is right. Mark Peterson's doing some amazing work there with Minister Bailey around getting the settings right and with the regulators to make sure that we aren't disadvantaged. So that's the first step. Getting more companies wanting to raise or access capital in the markets is the first step. The second part is the one of straight out liquidity. There are large holdings within New Zealand companies which aren't churned that often, and people continually, for example, they're held by councils or government, and as they go through their thinking around how they want to have their balance sheets, you may see further liquidity coming from those pockets, but that's not within our gift.
So is that suggesting that the government then could look or should look to selling off some of their stakes in the gentailers, in the likes of Air New Zealand, or councils in their port ownership?
Those organisations will do what's appropriate for their balance sheets. If they do that, that is an example of how you would get more liquidity into a market.
And companies like yours would be interested in investing in those if those opportunities came about?
Again, depending on the underlying performance of those companies and how they fit into the portfolios.
But more liquidity being released into the system, you think, would ultimately be a good thing for our capital market?
Should be.
What about small caps? There's these mid to small cap companies, the ones other than the 15 that you're actually investing in. Why are they struggling? Why are they not able to grow to meet that investability threshold? What needs to happen there?
There's also a competing force in the mid-cap space called private capital. So private capital is also now playing a bigger role in New Zealand than it has historically. So you list on the exchange to raise or access capital. Some of that need is no longer there as private capital is able to fulfill that need. So you're seeing a lot more of that occurring in that smaller mid-cap space.
Is that easier to access for companies as well? Is that now becoming a popular route because it is better and easier rather than listing?
There are pros and cons of listing versus accessing private capital. If you list, one of the big advantages is you do have liquidity for the shareholders. They can choose not to be invested with you, and they can sell their shares. That is an enormous bonus. In the private capital space, you have less liquidity. You are locked up with that partner, and if you don't like that partner or it doesn't work out, you're kind of stuck with them. So there's definitely pros and cons. You know, one of the perceived pros of private capital is that the cost of accessing it is lower than what it is to be listing on an exchange, which goes to the point about why we need to make sure it's an attractive place to list and not having the barriers to listing being too high.
Well, let's talk about how we do that. What functions need to be changed? Do there need to perhaps be concessions for smaller mid-cap companies to list on the exchange that aren't the large ones? Perhaps they shouldn't fall under climate disclosure, or perhaps they shouldn't need all continuous disclosure. I mean, are those the things that we should be considering?
And those are exactly the points which Mark is working on with industry support to try and encourage the regulatory settings to be appropriate for the size of the companies which are listing. And he's getting some great traction, and so I do feel very positive about the direction of travel with that.
Do you think that something like that would need to happen though? Is that kind of like, do there need to be function changes for this to make a difference?
I do think we need changes, and I do think we are going to see changes because of the way in which both regulators and government are positively engaging with both the market and the NZX on these matters.
Is there a risk that we then swing too far the other way and become an unregulated market, which we know wouldn't be good for investors either? So how do we find that balance?
Regulation's essential for any market. It provides protection for investors, it provides certainty, provides clarity, it creates the field of play. It's like a game of rugby. And you need a referee in rugby, but if you over-referee a game, you take some of the performance out of it. So it's about getting the right balance. The part I'm excited about at the moment is that there's an acknowledgement of this by the regulator and an engagement from the regulator on how they can regulate it in a way which works for the players on the field. So I do think you're absolutely right. We need regulation. Just making sure we've got the right balance with the referee is the key.
But if there is too much refereeing, as you call it, if there's too many rules, then that's the whole point of the capital market effectively being unproductive and underperforming, and then investors chase returns elsewhere, typically things that are too good to be true. Is that happening now?
I think there's a lesser risk of that. I think what happens is, what we're seeing at the moment is if you over-referee, people just don't want to play the game. And so they'll go and play in a different market because that's easier for them and it's more fun.
But there are still some companies out there. For example, I just got back from Wellington where I filmed at Resine Paints. Incredible New Zealand business. Their CFO said to me, we'd never list. Like, there's just no way. They don't want to be bought by private equity. They don't want to IPO. There's many other big companies out there, as you well know, that have considered listing and then gone, maybe not. Like, we're told that Trade Me has been teasing going back to the market for a couple of years, and we're still yet to see them, right? Investors are yet to get any inkling of when that might actually happen. So even if there are these changes at the edges, like, would that even be enough for these incredible companies, Fulton Hogan, another example in this country, for them to actually even consider listing on our market and being subject to public disclosure rules?
You've got to have a why for wanting to access capital. Resine may not need to access capital, Fulton Hogan may not need to access capital, so there may be no need for them to contemplate listing. Some people don't like the disclosure requirements because New Zealand's a very private country. And so having your financial affairs disclosed publicly, if you're a large, meaningful holder or a family-owned business which then gets listed, that sometimes carries a disproportionate weighting for some reasons for not listing. So I think every company situation is different. I think when you want to bring it back to what do we need to change, if you make it an attractive place to list and take off the table a regulatory burden or a financial cost of listing, if we can address those, you're not going to solve people's desire for privacy. There does need to be public disclosure if you are a publicly listed company. Those are some of the prices you pay for having access to that sort of capital. So I don't think it's necessarily about it fitting or being a solution for everybody, but for those for whom it is a solution, we need to make it an attractive one.
Is part of this also just changing the story around it? Like, you and I are so passionate about this and we talk about this often, but do we need to just flip the script and make people excited about listing, about celebrating the NZX?
It's an interesting topic to get excited about.
Yeah, you and I are weird, but we're a niche group.
Look, I do think listing is only one component of the capital markets. I do think the other component of the capital markets, which is likely to have a more immediate benefit, is how we think about investment into long-term infrastructure projects. Because capital markets, the companies and the evolution and growth of those needed to substantially change is a bit like the growing tree. You need to start, and we're starting, and so those changes will evolve over time. If we're looking for more immediate hits into our capital market, that's probably going to come from private capital and private capital into infrastructure. The exciting thing is we're now at least talking about it. Like, I do think one of the challenges we have, we need infrastructure as a country. I do think it's exciting that we're actually now talking about it as opposed to just talking about housing. That conversation's happening, which is great. I do think that's great. And I do think, although a lot of people might not find it exciting, they will when the roads start getting built and the bridges start getting built. But for that to happen, people need long-term certainty over what the plan is for New Zealand infrastructure. That requires cross-party agreement. And the exciting part there is that is at least now the direction of travel. The government recognises that you need to have bipartisan, cross-party support for a long-term infrastructure project, because long-term infrastructure projects take 10, 15 years, and with a 3-year government cycle, nobody's going to want to come and put capital to work in a government project if it's an uncertain outcome in 3 years' time.
This is the interesting thing though, because all of this, whether it's infrastructure or listed companies or private equity, all of it is in competition for capital. Do we actually have enough capital to go to all of these things and to help them all grow and be successful?
I do think we have access to enough capital, because we shouldn't be constraining our views on capital being the domestically sourced capital. Yes, we have that, and I want to deploy more capital into the New Zealand market. But we also have access to international capital, which is far greater in volume than we can ever produce locally. But that international capital needs the certainty of the environment to invest into. And so that's why I'm excited about the cross-party plan for infrastructure.
What are you seeing in terms of interest from offshore capital? Is your phone ringing hot? Like, are people calling you saying, MJ, what infrastructure project or private equity business can I throw some money at?
The phone is ringing very hot from overseas people wanting our capital. So that is one of the things about being at the size and scale we are now, is the phone rings hot from other private equity firms overseas wanting us to be investing into their funds, so they can then deploy it wherever they are in the world, sometimes including New Zealand.
What are you telling them if it's not New Zealand? No, we're keeping our money here, or?
Well, at the moment we don't have access to the size of opportunity we need to deploy it into New Zealand, so we are deploying it overseas, because it is also achieving diversification for our investors and accessing product and returns which you don't get here.
So while you're putting money in those opportunities, you're having this conversation because you actually want to put more of that money here. You just don't see those opportunities right now, bottom line.
100%.
Thanks so much for your time, MJ. This was a good chat.
Thank you.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.